Hey everyone, and welcome. It's really easy to get caught up in the big, splashy headlines, right? But while we're all looking one way, there's another story unfolding. Something quieter, but maybe a lot more dangerous, building up right under our noses. So today, we're going to pull back the curtain on that.
So think about it like this. On the one hand, you've got the stuff everyone's talking about, the visible storm. Geopolitics, crazy oil prices, the stock market going up and down. You see it on the news 24/7. It's loud, it's obvious. But there's this other thing. We're calling it the invisible humidity. And this is stuff like murky, opaque debt, tons of hidden leverage, and these little cracks that are starting to show up in the foundation of the financial system, right where nobody's really looking.
And this quote just nails it, doesn't it? The war is the storm, private credit is the humidity. I mean, you can see a storm coming, right? You can prepare for it. But humidity, it just seeps into the walls, quietly rotting everything from the inside out. You don't even know it's there until the wall crumbles. And that is the perfect way to think about what's going on in private credit right now. So what is this hidden danger? I mean, what are we actually talking about here? And why are huge institutions like the IMF suddenly dedicating entire chapters of their global stability reports to this? Something's up. Let's break it all down. Okay, so it all kicks off with what sounds like, well, like a magic formula. Seriously, it's this promise to investors that they can have it all the upside with basically none of the risk. Sounds pretty good, right? What we're talking about is something called private credit, and in simple terms, it's when these big investment funds, not your regular banks, lend money straight to companies. The whole thing happens behind closed doors, away from the public stock and bond markets. It's just a private deal between the fund and the business. And listen, this isn't some tiny niche corner of the market anymore. We're talking about explosive growth. It's gone up almost 10 times in just 15 years, and it's on track to be a $4.5 trillion market. That's just staggering. And why did this happen? Well, after the 2008 financial crisis, banks got hit with all these new regulations. That created a gap, a huge vacuum in lending. And you better believe Wall Street was more than happy to rush in and fill it. And this is the magic formula they were selling. This was the pitch. They told investors they could get the holy grail returns like you get from stocks, but with the safety and stability you get from bonds. And the best part? It supposedly has super low volatility, and it's not even connected to the crazy roller coaster of the stock market. I mean, come on, that sounds way too good to be true, right? Well, spoiler alert, it probably is.
Yeah, because when you actually start to poke at it, that perfect image, it starts to show some really serious cracks. So let's look at the three biggest problems here. Okay, crack number one. It's this concept called volatility laundering. Think about it. If you own a share of Apple, you know exactly what it's worth second by second. But with these private loans, there's no public market. The value gets updated maybe once a quarter. And get this, it's often valued by the very people who run the fund. So what you get is this powerful but totally fake illusion of stability. And this quote just says it all. It's like saying, it's not raining because my house has no windows. Exactly. Just because you're not looking at the risk doesn't mean it's gone. It's still out there. And this fake smoothness, this pretend stability, it makes these investments look way safer than they actually are. It fools everyone, from complex risk models all the way to the investors themselves. All right, the second big crack, it's in those supposedly amazing returns. See, there's a huge difference between the number the fund tells you they're making and the money that actually ends up in your pocket. The funds love to talk about a number called IRR. It's a theoretical number that can be juiced up with all sorts of financial tricks. The real number, the one that matters, is called CAGR. It's what you actually earn. And believe me, those two numbers can be worlds apart. Check out this wild, real-world example. The massive firm Apollo claimed it made a 39% annualized return since 1990. 39%. That sounds incredible. But some researchers did the math, and they figured out if that was a real compound return, their starting money would have grown to over $28 trillion today. That's bigger than the entire economy of China. The point is, IRR is often just a marketing number. It's not reality. And this leads us to the third crack. And honestly, this might be the most dangerous one of all. Liquidity, or the lack of it. See, these funds were sold as being semi-liquid, which is supposed to mean you can get your money out when you want. But as one writer for the Financial Times put it so perfectly, you can't be only a little bit liquid. It's either liquid or it's not. So here's the trap step by step. Investors start getting nervous, they want their cash back. So the fund goes, whoa, hold on, and they put up a gate. This means they'll only let, say, 5% of the money be withdrawn each quarter. But what happens when everyone wants their money out at once, and the requests are way more than 5%? Boom, the gate slams shut. Nobody gets anything. And just like that, your semi-liquid investment is now completely illiquid. Your money is trapped. So why the big rush for the exits all of a sudden? Well, it started with a few really public scandals. There was this company, First Brands, where it turned out their accounting was a mess. The books were totally cooked. That led to Jamie Dimon, the CEO of JP Morgan, making that famous comment, "When you see one cockroach, there are probably others." Basically, if you find one problem, you know there are more hiding just out of sight. And that fear, plus the fact that more and more of these loans are starting to go bad, has just created this massive wave of distrust.
Okay, so sucks to be an investor in one of these funds, right? But why should you or I care? Well, this is the scary part. This is where a problem for a few rich investors could spill over and become a problem for all of us.
Here's how it spreads, like a virus. First, the companies that got these private loans start failing. They default. So the private credit funds start to panic. To cover their losses and pay people back, they tap into huge lines of credit they have with, regular traditional banks. We're talking about an estimated $500 billion of exposure for the banking system. So suddenly, what happens in this shady corner of the market definitely doesn't stay there.
And this is the key difference you have to understand. In private equity, if you buy a company and it goes bankrupt, okay, the investor loses their money. It's sad for them, but that's kind of where it ends. But with private credit, it's a whole different ballgame. The risk is systemic. If this system freezes up, lending across the entire economy could grind to a halt. And that affects everybody. It's not an investor problem, it's a system problem.
So let's bring this all back to you. What should you take away from all this? Well, these kinds of investments are being marketed more and more to regular, everyday investors. So it's absolutely crucial that you understand what you're actually getting into. So if you ever look at one of these, here are 3 questions you absolutely have to ask. 1, what's the quarterly withdrawal gate? How much of my money can I actually get out, and how often? 2, don't ask for the marketing numbers, ask for the fund's actual default rate. How many of these loans are going bad? And 3, and this is the big one, if something promises you high returns with low risk, you have to ask the most important question of all, where are they hiding the risk? Because trust me, it hasn't disappeared, it's just buried somewhere you can't see it. You know, the legendary investor Howard Marks has this great saying, "The worst loans are made in the best of times." It's so true. The really stupid risks don't get taken when everyone's scared. They get taken when money is cheap and everyone thinks the party will last forever. Well, this whole private credit boom, it happened during the best of times. And now we're about to find out just how bad some of those loans really were. And that brings us right back to where we started. While we've all been watching the big, obvious storm in the headlines, have we been ignoring that silent humidity seeping into the walls of the financial system? And the real question is, are we only going to pay attention once those walls start to crack?